You're watching Stock Watch this week. I'm Ndauleng Lechela, and joining me to unpack your stock-related questions today, Ricus from PSG Hole and One Ruimsig and Rowan Williams from Nitrogen Fund Managers. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for your time this afternoon. And I guess it's only fair for us to start off looking at, the global markets picture, really a bloodbath following Trump's tariffs. Ricus, talk to me about how, to position yourself in this volatile market.
It's difficult. I mean, we are in uncharted waters as far as US policy is concerned, with basically reversal of a global economic system that's been in place since after the Second World War, where we're really moving into a tariff war environment rather than an organized trade environment. So what's driving fear at the moment is the possibility of not only a recession in the US, which that possibility has increased markedly, but also a global recession, and risk assets are being sold off, which is why we are seeing, even today, not only locally, but in Europe, markets off 3%. So the play has been and still remains to be pretty defensive, where bonds is a safe haven. The dollar is not a safe haven, and things like precious metals possibly is a place to park money, otherwise remaining in cash.
And Ricus, what's your strategy? Are you taking a more wait-and-see approach?
It's my personal philosophy that you can't just wake up one morning and discover that what do I have to sell in order to make myself safe. It is tactical. In other words, follow what the market is doing, having stop losses in place, concentrate on minimizing your capital losses, depending on where the market takes you. So it's certainly not wait and see, but making proactive tactical decisions as far as your exposure to markets in general, stocks specifics are concerned.
Rowan, I see you agreeing. Do you share the same sentiments?
Yeah, largely. I think we are facing a new world economic order. I mean, it's very fluid, the situation. Things may change. I mean, Trump has been known to make a lot of noise and have a very loud bark. I mean, at this point, the bite seems as bad as the bark, but he has indicated that he's willing to negotiate to some extent, but as we sit, we see China has already announced some reciprocal tariffs at the same level of 34%. So that's partly what the market is fearing, that there's going to be a trade war. And that's very regressive from an economic standpoint in terms of global economic growth. Trade sort of relations are going to be tested and shift. So I think you need to really have a good understanding of markets and who the winners and losers are and how things will fall. I guess you also have to really focus on the longer term. You should have a solid portfolio construction. That's one of the reasons you have it for events like this. And if you do have tactical cash, I think there will be opportunities that present themselves. Some things are looking extremely cheap, but they may get cheaper. So sort of watching the market timing where you may deploy further cash is important, but you do have to focus on the longer term. And it's going to be a choppy situation for a while, I think.
And talking about markets and sectors that are looking relatively cheap, we've been seeing that sell-off in the tech sector. And a guest then asks, is it time to buy the dip in that sector? Rowan, I'll give that to you.
Yeah, so I think you also need to look at the context of which we go into this. So the tech stocks have had an incredible run. The valuations are extremely high. I think a lot of those valuations are predicated on an extrapolation of record earnings which actually assume the continuation of the status quo in terms of supply chains, global aggregate demand, and continued penetration. And those assumptions, I think, are all questionable now. If you looked at Apple's share price down significantly, they have very integrated supply chains. They use Vietnam as a supplier, for example, where they slapped significant tariffs. So it looks like the cost of an iPhone could go up 20-30%. That's certainly going to dampen demand. In terms of any retaliation, that would have further impact in terms of their global consumer base. So, and the valuations are high. So I think they have potentially much further to come down. So I certainly wouldn't be looking at expensive tech stocks here. I'd be looking elsewhere for value.
Just sticking with that tech theme, Ricus, Microsoft recently announced that they'll be pulling back on data centers, or spend on data centers. What does that suggest about that AI picture, considering that tech stocks have been under pressure from the beginning of the year following what we saw out of China with DeepSeek spending less on AI spend?
Yeah, company specific, and for a lot of these guys, it's been the traders and investors taking a look at the capital spend that they have done since the start of the AI revolution and wondering whether they overspent on that. In other words, what return are they going to get on that capital spend in infrastructure? And secondly, from my perspective, people refocusing from people developing AI into people using AI. It still is a revolution, but I think there's a bit of sanity that comes back into the market. And if you take a look at, just for example, the S&P 500, it looks like it's heading back towards levels that, or a level that was last seen in about April of 2024, which really means that the run that we've had in world markets, which was driven by the American tech sector, is gone. So we're back to where we were in about April of 2024. And where were we then? We were then at a point where the market was looking at the US and saying, maybe the US is going into recession. We're exactly back to where we are there about a year and a half ago.
You know, we talk about recession talks, we talk about getting out of the market, or, you know, we're seeing a flight for safety. And there's a question here around, you know, uncertainty and what the safest place is to invest. Ricus, you touched on bonds. We also have gold reaching record highs. It did pull back. Where are you seeing opportunities in terms of safe havens? Rowan, I did also see the Japanese yen also extending gains as well.
Yeah, so I think what we're looking at is in the very short term, the cash is obviously probably the best place to be, as Ricus pointed out, not necessarily the dollar, because that is, devaluing quite significantly. So, as you say, some other foreign currencies, euro, yen, Swiss franc, for example, in the very short term. It does look like US Treasuries are showing some defensive characteristics. I guess, you know, if they do raise money from tariffs, it would improve their fiscal deficits. So they may be somewhat defensive. But I think in the long term, really, good companies are the best bet.
Yeah.
So as companies get cheaper, and I guess certain businesses are going to have less impact on demand, you would be looking at these businesses. We're seeing things on 3-4 PEs, which I think, you know, as long as the earnings don't collapse, those are extremely good opportunities here. So that's what we're looking at. Those would be inflation hedges and just be good for the medium term. So I think you have to look through the noise at these investment opportunities and look to pick them off.
What I see is a lot of our viewers just panicking and trying to figure out where to put their money. Now, Ricus, local markets weren't spared this week. We did have our own issues in addition to the tariff story with, you know, the GNU jitters, where we saw the ANC and the DA fall out during that budget vote in Parliament this week. How concerned are you about that political picture and how it may influence sentiment?
politics obviously always have a influence on our market, but politics historically is a distant third to what happens, as far as our equity market is concerned. Politics is third in the three factors that actually drive our market. And the first is the rand, and the second is the price of commodities. Obviously, we are seeing the rand now, I think probably going back to the sort of 19 rand, 80, almost 20 rand levels that we had, when was it, about two years ago? And it's partly driven by what's been happening with emerging market currency, that flight to safety and selling out of risk assets like the rand, and then obviously politics as well as just giving that extra oomph. But the political situation will, in some or other way, resolve itself.
Yeah.
I think the way we've been going at the moment was just, barely more than 1 GDP growth and 30% unemployment, whether you've got a GNU or not. It hasn't been the solution. Something else must happen. I'm not good enough to say what is going to happen, but we know that the situation as it is at the moment is not conducive to growth. But really what is going to drive us is what's going to happen with commodity prices, and that's a problem, because if we're going into a global slowdown, recession, our industrial metals is not going to save the economy in any event. So we are sitting with certainly most consumer-driven stocks being under pressure.
So let's continue with some of the questions coming through. I mean, yesterday we saw a sell-off in the financial 15. I think it was down over 5%. And that also being felt in the banking stocks. And there's a question here that reads, banks have looked relatively cheap. Is this a good entry point, Rowan?
Yeah, certainly the metrics are extremely attractive. The dividend yields, some of them are pushing double digits, so over 10%, and PEs 5 to 6. Obviously exposed to South African growth, but that not much is priced in terms of expectations. So they're very much sentiment driven, and we've seen them have quite a strong rally post the formation of the GNU in June last year, but now that's at question. I think foreigners are selling significantly, what the new global trade order means for the South African economy and not entirely clear.
Yeah.
So, in the short term, seeing a significant sell-off. Most of them are actually cum dividend as well, so you're going to get that in the share price at the moment. So they certainly look attractive at this level. I think even if the economy just moves sideways, the earnings are there, the dividend yield is there. So those are an example, as I was giving earlier, of good quality business at a very reasonable price. For the medium term, I think it is a safe bet, and you will do well as an investor picking up some stock here.
And Ricus, what's your assessment on, these banking stocks? The viewer also says that Absa looks quite cheap compared to its competitors. Is this one you're looking at, or are you looking at the other counters in the space?
Well, firstly, I totally agree with Rowan. If my interest get peaks once the markets settle at some point, I think South African banks would at this current valuation and even lower down will be very, very attractive. But in a market that is uncertain, you don't really want to go for the worst fundamentals in any company. And I think Absa is unfortunately in no way as healthy or as attractive as something like Standard Bank, for example. So you go for quality in uncertain times, and if you can get quality at a very cheap price, that's what you go for. When markets are booming, then maybe you can take a bit of a bet on something that is in a recovery situation. But no, I won't go for the cheapest. I'll go for the best quality at lower prices.
All right, let's talk about the retail sector here for a bit, because, we spoke about economic growth and some of the counters that act as a defense in this kind of environment. The retail sector, clothing retailers in particular, we've seen, their share prices come under pressure over the past few months. We are seeing low household spending, with perhaps consumers looking to spend money on things they actually need. When it comes to those clothing retailers, we are seeing the ones on the lower end sort of benefiting, so the likes of Pepco. Just your general reading on, what's been playing out in the clothing retail market, Rowan.
Yeah, so we have seen, again, those stocks had rallied quite strongly post the sort of GNU formation, and actually have retraced already quite significantly, as it looks like, as you point out, the sort of consumer recovery is stuttering. We've had some rate cuts, but they haven't really been sustained, and now we may be moving into an inflationary environment again, so those are not entirely clear. The rand's weakened again, which may also push up imported goods costs, and we've got the tax hikes, the VAT increase, so these are all not positive from a consumer perspective. I think something like Pepco, it is quite defensive. It seems like the lower end has been somewhat defensive, and demand has been okay there. I mean, we will see a moderation, I think, in food inflation and, importantly, fuel inflation with the drop in the oil price. So those are, I guess, supportive, and sort of speaking to Ricus's point, something like Pepco is quality, and so maybe if you're getting it at a better price here, again, I think the medium-term demand is good. The exposure they have to Brazil is very interesting. So it's, again, worth looking at, but I think you do want to sort of pick it off slowly. It is a very uncertain environment, and I guess they could get a little bit cheaper before they stop falling.
And in this uncertain environment, we recently saw Pepco make quite a hefty acquisition just to try and expand its adult range wear. What have you made of that move, Ricus, particularly the Boardman's acquisition as well, because it's quite different from its Pep Home offering? Well, in terms of a price point,
Was Boardman's part of that deal? I'm not sure, but what interests me there is the move into shall we say, the higher LSM groups, which is part of Pepco's strategy, where they've changed, the fundamental foundation of the company. They move into fintech, which I found very interesting, which is also why it's my preferred stock in that sector, and now the expansion into more the luxury end of the market. I think there's lots of scope there for them to turn that around, and I think they will be able to do it. So yeah, it's my preferred clothing retailer, but as Rowan said, it's cyclical, and we're not in a cyclical boom at the moment, so maybe you can pick it up lower. But if I want to have exposure in that sector, that would be my go-to.
All right, there's a question here on Remgro and Raynet. The viewer asks, which is a better value to buy, Ricus?
Yeah, well, it depends. If you want offshore exposure, you go for Raynet, because that's where your exposure lies there, whether it be, and specifically in the financial sector. Remgro is very much a South African play. They had a well-received set of results, and the price shot up to a resistance level at around about 160 rand, where they haven't gone above for the past 5-6 years. I don't know, a very long time, and they've pulled back ever since. But yeah, if you want some kind of South African SA Inc. exposure, you can go for Remgro's. Otherwise, Raynet is a pure financial offshore dollar-based play.
And I see you nodding there. Rowan, do you share the same sentiments?
Yeah, I think at this point, some diversification of your risk away from SA Inc., I think is sensible. The other important thing is a big portion of the market cap of Raynet is now cash after they sold the BTI, the British American Tobacco stake. So that's the kind of thing we're looking at, where the shares are still selling off regardless of what the assets are. And in some instances, they actually cash, and we just spoke about that earlier. That's the most defensive place to be. So you could argue that the prescient sort of management teams have seen the market's very high and have sold a big portion of their portfolio, and they're not really being rewarded for that, which is quite interesting. So, but as an investor, again, the cash is there, so it's fairly safe. So for me, that's a better bet here.
All right, let's move over to Cecil. We were just saying during the ad break that there's always a question around Cecil. The viewer says here, just your take on the counter. I see the stock has dipped lately, and this reminds me of COVID. I always kick myself for not buying it then, as I told someone about it, and he made a few hundred thousands. Should I consider adding it to my portfolio? Rowan, I'll give that one to you.
Sure. Yeah. Look, I mean, it certainly had a remarkable bounce post-COVID, but as you see, the shares almost retraced back to COVID levels. So from a long-term perspective, it actually hasn't been a great buy.
Yeah.
And it has a number of structural challenges which remain. I think the new management team is doing a better job of sort of addressing those and being more reasonable about sort of greening the business. But we mentioned the oil price is down significantly, so that muddies the waters. A business that's got some significant sort of operational headwinds, and now their main commodity that they sell, the price is coming down, doesn't look that positive. So we are quite negative on Sasol and remain so. So yeah, we would still not be adding it to it here.
All right. Before I let you go, gents, let's get your stock picks. Ricus, I'll start off with you.
It's Bidcorp, which, as you know, is basically the European food supply business. The problem in the global markets at the moment is supply chains. If you're a company that depends on a global supply chain, you've got a problem. Bidvest is not in that position because they are, what they sell is what gets manufactured in Europe, and I can't really see a trade war between European countries in itself. So they are protected from the turmoil of global trade problems. I think they are sitting at a decent valuation. I think Europe as a continent, as a whole, probably has better growth prospects than a lot of other areas globally. So it's a company that's specifically in that geographic environment, decent valuation, and less risky than a lot of other big companies that you can go for offshore.
And Rowan, what are you hanging your hat on today?
We are going for something closer to home for our stock pick. So Super Group, I think the key attraction there, I mentioned it earlier, is that essentially 60% of the market cap is cash in terms of the proceeds that they're going to get from the disposal of SG Fleet. And that is imminent. And so you're left with the balance of the business, which is more South African focused supply chain operations. So I guess in the short term may be impacted somewhat, but as you've seen that most commodities are excluded from tariff, so those are less impacted. Demand may drop, but I think again, very low expectations in the what's left of the business. So you're getting it extremely cheap. It's going to be de-geared, and I think it looks like a very attractive prospect at these levels.
So Super Group and Bidcorp wants to look out for. Gents, thanks so much for joining us this afternoon. Thanks to my guests, Ricus from PSG Hole in One Ruimsig and Rowan Williams from Nitrogen Fund Managers. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 on Fridays. Keep that in mind when you send your questions. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.